Normally, when the stock market peaks, you go back to 2000, 2002, 2007 to 2009, bonds are a place to be. Money moves into gold and into T-bonds. People are seeking an alternative, a place to be. It might be shelter. And the other place they're looking is gold and silver. And people don't realize it, but gold's up more on the year than the S&P. Nobody's cheering it, though. It's up more percent year to date than the S&P. Anyway, that'll be the other alternative. So that's why we're focused on the stock market, because when it does crack, money's going to flow.
2024 has been a standout year for precious metals, with gold leading as a top-performing asset class. Bullion has demonstrated exceptional strength, inching closer to a historic milestone. Gold prices are now just a few $100s away from the $3,000 threshold, reflecting significant growth throughout the year. Starting at $2,073, gold has climbed to $2,636, marking an impressive gain of nearly 30% with just 1 week remaining in 2024. Meanwhile, U.S. stocks are also experiencing a banner year, with the S&P 500 index on track for its second consecutive year of strong positive returns. November was the best-performing month for the index, bolstered by a decisive election outcome and a well-received Fed rate cut. Annual performance so far rivals the impressive 26% return seen in 2023, a rare feat, as U.S. stocks have delivered total returns above 20% in back-to-back years only 9 times since 1928. MichaelOliver, the esteemed founder of Momentum Structural Analysis, brings decades of expertise in using momentum indicators to forecast significant shifts in stock markets, commodities, and monetary policies. He highlights that gold has quietly outperformed the S&P 500 year-to-date, a fact often overlooked by mainstream analysts. Oliver predicts that gold and silver will draw increased capital as safe haven assets as the stock market weakens. He cautions investors against being influenced by daily price fluctuations, urging them to focus on the broader, long-term trends instead. We're about to explore the video, but first, subscribe and hit the bell icon to keep up with our newest uploads. Your feedback in the comments is always appreciated.
Normally, when the stock market peaks, you go back to 2000, 2002, 2007 to 2009, bonds are a place to be. Money moves into gold and into T-bonds. Gold and T-bonds performed very well as the stock market peaked in 2000, 2007. For the next couple of years, gold went up, bonds went up. In fact, gold went up through 2011. But during those times, those two were the alternatives. So why aren't, our assumption is, and this is just broad based on that knowledge, when the stock market does begin to crack, especially by our metrics, the T-bonds will start to firm in price, drop in yields. Not because the Fed cut rates, it has nothing to do with that. We're talking long end. No, the long-term trend in T-bonds is negative, meaning higher yields, lower price. But even in a major trend, you can have a counter trend move. Markets inhale and exhale. The technicals for bonds look poised that once the stock market fractures itself, it initially, it doesn't have to crash, just it starts to break 5% off the high, 10%. You'll see the T-bonds being pursued by asset managers who are looking for a place to be that is better in their perception than high risk, low reward stock market. And there's plenty of asset managers out there who've expressed doubts about the stock market based on, the long-term fundamental type metrics and assumptions. And they're right. It is distorted. It is way off the page, but the issue is the timing. But when you start to see that market crack, our bet is that the technicals that we see, the momentum technicals in T-bonds, could spark a sharp rally, a drop in yields. And not because the Fed's doing something. No, it's because people are seeking an alternative, a place to be. It might be shelter. And the other place they're looking is gold and silver. And people don't realize it, but gold's up more on the year than the S&P. Nobody's cheering it, though. It's up more percent year to date than the S&P. Anyway, that'll be the other alternative. So that's why we're focused on the stock market, because when it does crack, money's going to flow.
Do you still see precious metals to go higher when the stock market crashes?
Yeah. You can ignore the daily similarities which occur from time to time. And there are times when it does occur. One time it didn't occur recently, for example, was when Trump got elected, the day after. It was an orgy of buying in the stock market and an orgy of selling in gold. So, his comment is true. Yes, the other day we had a similar drop, but look at what happened after the election. Gold dropped down to $2,540. Right now it's $2,650, by the way. It's well above that sell gold orgy after the election. In fact, it's above the levels it was prior to that orgy beginning. And the S&P right now, by the way, is back below the levels where its buying orgy began after the election. So don't look at the day-to-day. It's nonsense. Look at the bigger picture. And even in that regard, the panic selling that occurred that November 6th and 7th on gold and buying on the stocks was totally opposite and quite significant. But it didn't last. They've started to go back this way, okay? So I would ignore the day-to-day. Look at the bigger picture. And if you go back 100 years, 100 plus years, we just put out a report on this the other day. My son penned it. Was, where do a long-term investor, let's say somebody who's thinking 10, 20 years out, to park his portfolio, stock market, it's ever up, right? No, it isn't. If you go back and examine carefully, there's many times, like 4 major times at least, where you'll have a major top in the market, a sharp drop, 28.9 to 32, for example, but it takes years to get back to the price level you saw prior to the drop. Oh yeah, there's an upturn. But when you also factor in the ongoing decay in the real value of the money because of the increase in the money supply that occurs decade by decade, almost doubles every decade, then let's take NASDAQ 100, for example, 2000 dot-com top, it collapsed 82%. Well, if you didn't get out then, and we did say sell in January 2000, now it took a year before it really started down. But if you didn't get out in 2000, it took till 2016 to nominally get price back to where it was in 2000 for the NASDAQ 100. 16 years.
Silver's extensive history as a store of value, spanning thousands of years, places it in a unique category alongside 2 other notable assets: gold, with an equally enduring legacy, and Bitcoin, which has emerged only since 2010. In 2024, silver's exceptional performance was fueled by a combination of macroeconomic factors and increasing industrial demand. As industrial applications for silver continue to expand, particularly in renewable energy and technology sectors, alongside its safe haven appeal in uncertain economic climates, silver could solidify its standing as a versatile and highly sought-after asset. Oliver believes a return to $35 for silver would confirm that the bullish trend remains intact. However, he emphasizes that once silver clears the $33 range in the near term, it could accelerate, rushing to new highs. Now, let's redirect our attention to a video.
They've already achieved that back in March, and so already momentum is positive, having zigzags, but the annual momentum using a 36-month average of silver, that price chart had this minor ceiling at 25, 26 level. But you go back on that annual oscillator that we issued back early this year when we showed warning of the breakout, 25, 26 zone, was massive, more massive than even that price chart thing. And so we're well above it. So the only thing we're looking at now are more intermediate type metrics. Like we run a 50-day oscillator of silver and 100-day and stuff like that. And we'll argue this: if it takes getting back to 35 to convince you that everything's still okay, get back to the high. You get above 33, you better watch out. Okay, so that's sort of in the middle of nowhere if you look at that price chart.
Yeah.
But get back over 33 in the next, couple weeks or a month, they're going to blow those highs out. And you're probably in the acceleration, the more vertical phase. We had originally thought that might occur prior to the election. It did not. But we're still right on our assumption that in March, if you weren't already in silver, you should have bought it at 25, 26 zone. And for gold, that zone was between 2,000, 2,100 on annual momentum. And it was again coming back up to what? It had been above 2,000 3 times prior to that. So it was coming up a 4th time. We said this time it's different. So again, we think the acceleration phase will occur. We need that other asset category to crack. And I think we're on the verge of that. That's an idiot price chart level, okay? In other words, any idiot with a price chart look like, hey, you hit 50 there, hit 50 there, I'm going to sell at 50. Okay, fine. You can do that if you want. Our bet is when you get through this phase we're in right now and you clear that stupid 35 level, which is meaningless, really, not even meaningful on a price chart. It's not even meaningful in momentum. It's just a round number they picked, okay? You get through that level and we're going into the acceleration phase. $50 will be blown out. And, I've got some biases, but they're not hard noodle. They're wet noodle biases where that first surge might carry, but demonstrably beyond 50 before it even pauses. In other words, anybody who thinks that might be some kind of pivotal level and they're not going to get committed to believing in it until it clears it, well, it's going to clear it the next time. You're not going to arm wrestle your way up there all the way. You're not going to go up 5, pull back 3, you got 5. There's a point at which you'll go zapping through that level. And again, I argue that is likely when this next upturn occurs, especially when that upturn occurs and money starts to flow. Because remember, the money flow out of the stock market will be massive. That category is huge. It doesn't take much money flow out of that to blow the monetary metals through the roof in terms of dollar volume, okay? And that is likely to occur in a matter of weeks, months, not years, okay? And when that occurs, you'll start to go vertical. And I've made this point before about $8,000 gold. People say, oh, you predicted $8,000. Yeah, ultimately, it's a silly number, and I'll tell you why. If you go back in the history of gold bull market since it was legalized, there have been a couple eightfold plus moves, okay? Let's take the 2000 to 2011 move. You went from about $260 to $1,920, okay, about eightfold move, okay? The prior peak in 1980 was like an eightfold move from even the correction low in 76. You went from just above 100 to 850, okay? Hey, it's no big deal to have an eightfold move. You've done it twice. 1976 low, correction low. After you hit 200, you went back to 100. And 2000, 2011. So you've done it twice. You look at a log scale chart, you'll see, oh, same dimension move. Well, if gold were to replicate that from bare low 1,050 in 2015, it'd be over $8,000. So is that some kind of scientific prediction? No. It's simply noticing, hey, you've done this twice before. It's no big deal to do it again, particularly given the dynamics that are in play this time as opposed to then, in terms of causing massive damage in the economy, massive damage to people's portfolios, massive damage to emotions, and massive panic by the central banks.
Since the beginning of 2024, gold prices have surged by nearly $600 per ounce. To hit the much-anticipated $3,000 mark, gold would only need to gain a few $100s more. Analysts project a more conservative year-end price of approximately $2,800, with many forecasting that the $3,000 milestone will be more achievable in 2025. The movement of gold and silver prices is primarily influenced by market sentiment. Investment demand plays a pivotal role in driving these prices up or down over time. While gold and silver have served as trusted assets for wealth preservation since pre-biblical times, a modern contender, Bitcoin, shares some of their key attributes and has joined the conversation around alternative stores of value. How do you see the role of precious metals evolving in a world increasingly focused on digital currencies? We welcome your insights in the comments section below. If you found this content valuable, don't hesitate to give it a thumbs up and don't forget to subscribe to stay informed. Thank you for joining us on this journey.